Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today we're talking about the new legislation proposed by the government, which is going to be looking at upward-only rent reviews. Now, upward-only rent reviews is a mechanism in a commercial lease whereby basically the rent can't go down. So every time there is a rent review, that's usually every 5 years, but it can be more frequent or it can be a bit longer. Then what happens is that there's either a nil increase, i.e. the rent will stay the same, or the rent will go up, depending on market conditions. And usually what happens at rent reviews is there's a negotiation between both parties and, comparable evidence is produced. And if the parties can't agree, it will go to an arbitrator or an expert appointed by the Royal Institution of Chartered Surveyors or the RICS. So that's an overview of kind of what this is. And so what the government wants to do is that they want to get rid of these upward-only rent reviews. And the logic they're saying is that it will help the high street because basically retailers in particular are being affected by, if rents are going down, they've not got any mechanism in their lease for rents to go down. And therefore they're kind of carrying on paying a prohibitively high level of rent when rents on the high street have gone down. And of course, we saw rents go down during COVID quite frequently, but a lot of leases just didn't have the provision for the rent reviews to reflect that. Now, rent reviews are on a certain anniversary, so they can't just be triggered willy-nilly. And obviously rents can be renegotiated at the end of leases as well. So what the government's proposing is that upward-only rent reviews are abolished, and that, we've seen kind of index-linked like CPI, RPI type rent reviews, they will go as well. And there has to be ability for CPI or RPI linked rent reviews to go down as well as up as well, although we haven't seen negative inflation for quite some time. So why am I talking to you about this and why is it important? Well, I really want to get on to the fact why this is important for your investing. But let's talk about the implications on a wider industry basis. So we are in a commercial property market in the UK where prices have gone down. We're, in a down market. We've been in a down market for the last 2.5 years. And despite the industry kind of talking the market up, we haven't seen a recovery yet. And recovery has stalled because of bond yields going up. Commercial yields are still high because of jitters over Trump's tariffs, because of actually this current government's policies not being particularly business friendly. And so, recovery has stalled. And what we really want most of all in this market is a government that's going to be supporting business growth. And, if businesses grow, commercial property grows. And we just need more confidence in the government. We need more confidence in the economy, which we're just not seeing at the moment. And it's not entirely UK PLC's fault. There's global factors at play as well. But what we certainly don't need at the moment is any more uncertainty or jitters in our industry, in the commercial property market, because we all know that when markets are starting to recover or wanting to recover, that everyone feels jittery. And so anything that sets that back is bad news. And so just at the time when we need the market to be recovering, we need confidence to come back into the market, the government kind of hits this bombshell. So it's not great from that perspective. And what you need to remember as well is that a lot of commercial property investment comes from overseas. It comes from institutions who have an allocation for commercial property. And the reason that the UK has been such a fantastic commercial property market for so many years is because we have a different market than we have different lease structures than a lot of other countries. We have longer leases, we have upward only rent reviews, and basically investors, they actually seek out UK commercial property for the reason that they can get longer leases, they can get upward only rent reviews, which gives them more certainty for their investment. And that's true for overseas and UK-based investors. It's just become we call it an institutional class investment. It's an institutionally acceptable investment in that the downside is covered, there's long leases, and there's inflation-linked growth. And, when we've seen upwards and downwards rent reviews kind of being adopted, those assets are very, very often not very attractive to institutions because obviously there's a risk of rents going down. So it's not great. So just at a time when a lot of overseas investors are worried, are concerned about investing in the UK at the moment because of the economy, because of the current government, not being business friendly, not being entrepreneur friendly, not being property friendly, then, just at a time when we need that confidence to be increased, the government has brought this out. It's not law yet. It's not set in law, and they haven't consulted the real estate business as well. The real estate industry hasn't been consulted. So this has come in draft legislation on the 10th of July, and it's completely out of the blue. Now, the cynic in me says that's intentional because there's a lot of big business, institutions, pension funds, big PLCs that invest in commercial property, and the lobby against this will be quite significant. So we'll see how that plays out as this kind of moves to become law. So it's certainly not done yet. Attempts by governments to do this in the past have also failed. And actually, where this has been introduced in other countries worldwide, what we've seen is purely that higher rents have been agreed up front. We've seen shorter leases, so there's more ability for leases to be renewed more frequently. We've seen more landlords break clauses coming in, which basically give the landlord the ability to increase rents by virtue of a lease renewal rather than as a rent review. So it's all up in the air. Now, I'm very, very strongly believe, and if you've listened to this podcast in the past, you'll know that I believe in controlling the controllables. So we can't control what governments do. We can't control what happens with legislation. What we can control is our own investing. We can control our own strategy. And of course, we need to be very mindful of what's happening in order to flex our investing and to make sure that we kind of follow the trends and we don't get caught out. So that's super, super important. And, part of me does wonder whether the government's introduced this mechanism so that they can basically not overhaul the business rate system, because the business rate system, government, the current government had a manifesto pledge to overhaul the business rate system. And of course, they can't afford to do that because they have this tax black hole. So in fact, what they've done is they've increased some business rates by like 200% on the high street. And that's been done by stealth. So, logic, if they can reduce rent, then there's more ability for businesses to pay business rates. Maybe that's the cynic in me coming out. Who knows? But listen, let's look at what we can control. So this is a well-worn path. We've seen governments try to do this. If any government was going to do it, this current government is going to do it. Let's face it. So let's kind of just put that to the side. When I've been talking to my clients about this as an issue, the one thing that I'm very, very clear on is that it really shouldn't change anything. No, so we will see valuers and the RICS kind of flapping around about kind of how you value this. And, quite rightly, because there will need to be some new valuation guidance and, there'll be a period of bedding in, this is if it happens, there's no guarantee that this will happen or it'll happen in its current form at all. But the fundamentals stay the same. So really, that as far as your property strategy, as far as your property investing, that if you're doing what you should be doing, if you're doing as I teach my clients, as I do myself, then there should be business as usual. There should be no change. So why is that? Well, basically, what I strongly recommend you do with your investing is with your commercial investing is to niche your strategies. Now, niching is so important in commercial property, and there's a whole podcast on niching. So go back and listen to that if you want more details. But what niching is so important in commercial property because it is because it's the only game in town, because there's so many different types of commercial real estate out there. There's so many different types of investing location. There's so many different types of tenants that if you scattergun invest, if you don't niche, if you don't find these kind of needle in a haystack type opportunities where you can really clean up in your investing, then you're going to be seeking out substandard returns. You might get lucky on a few, but there's no strategy behind it. And at the end of the day, when we niche, what we don't do is we don't niche in sectors where rents are going down. We don't niche in sectors in locations where there's no tenant demand. Of course not. That would be ludicrous. What we do is we niche in locations where there's great socioeconomics for the particular type of tenants that you're looking to attract. We, and their customer is located locally. Or it could be, if it's an office, that their workforce, the particular type of labour they're looking for is located locally. So this is one of the reasons, for example, why tech businesses cluster together, because they're a magnet for that particular very, very niche and skilled workforce. And so that's why they cluster together. So GCHQ in Cheltenham attracts tech workforce, and therefore there's a reason why lots of tech businesses kind of locate nearby, because they've got the right kind of workforce. Similarly, with industrial properties, they're near the right customer, the right workforce. If there's lots of chimney pots, kind of average kind of price housing, then the workforce is there for them. So there's, when we're niching, we want to look at these kind of things. We look at whether there's many voids on the industrial estate, and in the office sector, in the retail sector, the hotel, whatever we're looking at. Are there many voids? Are there many vacancies? If you walk down a high street and every single shop is occupied, and there's loads of people walking down the road, and everything feels thriving and buzzing, then there's, that's a really good indication that there's loads of demand. And if you can locate, if you can find investing locations where, say it's retail, where there's a short high street, fully occupied, yes, there might be the odd void come up, but that's an opportunity, not a problem. If you're looking at a location where there's 30 void units, and it might seem churlish to say that, but there literally are those locations, probably 30, 100 voids on some high streets, then why would you buy an investment there unless you can kind of pivot and change the use into something where there's more tenant demand? So tenant demand is so important. And we need to look at property locations from a tenant's point of view. We need to look at the type of tenant we're going to attract, and supply and demand is so important. And so if you're buying a property where there's a load of demand for it, there's not much supply, or you can do something to that property where you can reconfigure it to make sure there's more demand, where you can get higher rents, maybe longer lease terms, then do you think that you're going to be affected by this legislation? And that's the question I want you to think about, because ultimately governments will do what they want to do, markets will do what they want to do. But, if you stick to the knitting, if you stay to the fundamentals of what makes a great commercial property investment, you want to find something where there's supply and demand in your favour, where there's great tenant demand, where you can get longer leases, where there's potential for rental growth, or where there's something you can asset manage on the property, where you can attract all of the above. And ultimately, if you're niching your strategies to find those kind of investing locations, then this legislation, whilst it may be annoying, can't really hurt you, because you're going to get rental growth. You're going to get longer leases. You're going to get tenants who want to stay in that particular investing location because they're trading really well. Why would they want to leave? And because they're trading well, they can afford to pay higher rents, because they're offsetting that against their trade. So niching is the key, and niching always has been the key, and that's nothing new in this market. It's all about niching in commercial property.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
So rather than being kind of worried, oh my gosh, should I invest in commercial now? Is this an area of concern? See this as an opportunity, because what this is going to do is going to turn people off commercial investing, kind of people who are uneducated, people who don't understand the sector. And it will create some fear. Certainly might be short-term fear until everything beds in, or it might be slightly longer-term fear. It also might have a positive impact in that, tenants will feel more relaxed about taking units because they feel like they're not going to be tied into super high rent. So therefore, maybe they're more willing to agree a higher rent up front. So, kind of don't be fearful about this. Legislation will happen. Obviously, lobby groups are going to be out in force. And of course, there's always two sides to every story. Small businesses will be delighted that this is coming through, and they may be more willing to take commercial units as a result of it. So perhaps it might boost the high street. Personally, I'm cynical on that, because I think if small businesses tend to take shorter leases, not to have rent reviews, you only really ever see rent reviews after 5 years. So I think that this is very misguided, because actually the tenant group that governments are purporting to support actually probably aren't going to be that affected by it, because they take shorter leases anyway. Personally, I think this is a cynical attempt to try and make business rates more affordable, but maybe I've been around the block too many times and I'm too cynical. But I think the overwhelming message that I want to leave you with really is, well, let's watch this with interest. Let's see what's happening. But if you're investing in the right location and the right properties in the right location, the right configuration, the right position in a particular industrial estate or business park or high street or whatever, and that there's great tenant demand for your unit, then the fundamentals are there for rental growth. And so you're not particularly fearful about rents going down. Now, obviously, we need to be protective of this, because sometimes you can get the wrong result that comes out of rent reviews. So that it needs some thinking about going forwards. And don't forget, this legislation isn't current now. So if you can buy commercial units now, don't forget, we're still in a down market, so prices are lower. And actually, if you can get leases now with rent reviews, then happy days. That's a good thing. It's also going to make properties with longer leases more valuable, because they'll have rent review provisions in there for a longer term. So there's kind of a happy effect of that, I guess, as well. So niche strategies, I think that's the overwhelming message I want to leave you with. So how do you do that? Well, you need to find locations where there's great tenant demand. It's pure and simple. Now, obviously, there's two ways you can invest in commercial property. Number one, you can just park cash and get a yield. So a lot of business owners, a lot of kind of people who have spare capital will do this. They will almost see it as a pension scheme. They will put money into commercial at maybe somewhere between 7 and 10%, and they will park their cash in there and they will get a return. The other way of doing it, of course, is to buy something, say at 12%, and do some asset management, and then reduce the yield to say 10%, increase the rent, and get money out and add value. So you want to be looking at, if you're in that second group, which a lot of my clients are, then you want to be finding those locations where perhaps you can create units that have more tenant demand than the existing ones. So I've got clients really successfully doing this across all sectors, particularly in industrial, actually, where they are buying larger units where there's not much demand, and splitting it up into smaller units where there's more demand. And if you want to know more about that as a strategy, listen to my previous podcast with one of my clients, Onki Bell, who talks through kind of how she found that niche and how she implemented that particular strategy. It's a really great listen, so I'd highly recommend that one. So find those locations where the demand outstrips supply. Obviously, make sure that's future proofed as well. So we look at the trends. Are the trends in the favour? That's why light industrial is very attractive to investors, because they can see that actually light industrial ticks a lot of boxes for future trends. And then when you've bought the assets, you just need to, whilst commercial is very hands-off income, from a lease perspective, just make sure you're monitoring what's happening locally. Make sure you know where rents are going. Look for changes in that particular investing location, maybe businesses coming in, businesses leaving. If that particular investing location is very dependent on particular business, like a steel industry, or a business that's closing down, a car plant or whatever, then obviously you need to be really monitoring that very carefully. What we don't do is we don't hold on to assets long term in commercial if we can see that trends are moving against them. So we don't necessarily need to sell them, but we may need to pivot. We might need to asset manage them, or ultimately potentially sell them off before they go into a decline. So I'll give you an example of this. I was working in the corporate world up until 2015. I was managing a very large portfolio of shopping centres. And deep in our hearts, we all knew there was too many shopping centres on high streets. We knew that retail was in a downward spiral. We knew there was too much retail on high streets. Valuers were desperate to reduce rents and to move yields out. But a lot of the corporates, were kind of saying, well, no, let's kind of hold. And valuers don't like, to make big sweeping changes. So, there was a deep feeling that actually we were pushy against the tide, but there was no reason why anything needed to change. It was a bit like death by a thousand cuts. We'd see rents going down by maybe 10 pence a foot or something like that, and we try and do lettings to try and keep the evidence up. But we knew that trends were moving against a lot of retail. Online shopping was coming in. There was too much retail on high streets, but shopping centres were doing pretty well. Again, there was probably too much space in them. Then, of course, along came COVID. And basically what it did was exacerbate the trends that were happening anyway. So whereas it might have taken 10 years for everything that happened in COVID to have happened otherwise, it happened in a year, really. And so valuers use it as an excuse to slash rents. Yields moved out. Tenants got jittery. Lots of tenants failed. Obviously, we saw big high-profile failures like Debenhams, like House of Fraser, like the Arcadia Group, Topshop, etc. And, it's kind of like one of those forest fire situations where, when the forest recovers and the green shoots come up, only the kind of slightly more healthy businesses survive. But I guess the point I'm trying to make is that we knew in our hearts that retail was going to change at some point. We just didn't think it would happen so quickly. So what we mustn't do in our own portfolios is hold on to assets longer than we think we need to. Now, some assets you can hold for 20, 30, 40, 50 years, and lots of investors do, and they're still really great performers. There's still tenant demand, and that's what we're aiming for. We're not aiming to try and sell things out, but things will happen. Locations will change, economies will change, demographics will change, and we need to keep an eye on that, because if we do need to, we need to be active portfolio managers. Commercial is less about being investors and more being about portfolio managers, and really understanding how to manage your portfolio well, and that's where you'll be really successful in commercial. So I guess the message I want to leave you with today is, if you're doing what you should be doing, which is niching your investments, buying the right property in the right location, there's no need to worry about any of this. Yes, there's going to be some jiggery-pokery going on. There's going to be quite a lot of noise about it. But there's also going to be a world of opportunity here as well, especially if prices stay low for longer. So, see it as a period of opportunity, monitor very carefully what's happening. And obviously I'll keep you posted on this podcast. And obviously I'll keep my clients really closely posted as to what's happening. But ultimately, if you're doing what you should be doing, which is niching your investments, which is, buying in areas with great tenant demand, and your particular unit can cater for that, then you should really have nothing to worry about. So, don't be afraid, be strategic, and make sure that you niche your commercial strategies.